Good Monday morning. My name is Drew Wright. My MLS ID number is 589370. And every Monday, we like to come to you with an email and a video about mortgage stuff, so to speak, rates and things of that nature, keep you updated on what's going on in the mortgage industry, maybe give you a little knowledge about things you didn't really know about before. But this week, our topic is the new conforming loan limit. In other words, Fannie Mae and Freddie Mac are the government-sponsored entities, GSEs as they're called sometimes, change the amount, a dollar amount of what they will buy in a loan every year. It currently is 806,500. So this means that Fannie Mae and Freddie Mac will buy these loans from banks and independent mortgage companies like ours, and then they can basically resell them in the secondary market, creating liquidity within the mortgage industry to give you lower rates. These are called, quote, conforming, because that means Fannie Mae and Freddie Mac are going to buy these loans. Any loan amount above the 806,500 threshold, which is the general number used, there is a higher number if you're in a high cost area like LA or Washington, D.C., or other high cost markets. But generally speaking, certainly the areas that we cover and talk about here, the limit is this 806,500. So those loans that are at that point, again, sold, loans above that are called jumbo loans. And so jumbo means that the banks hold them on their balance sheets, or so-called portfolio loans. The borrowers that get those loans supposedly are more qualified from the standpoint of being able to handle financial setbacks. They have higher incomes, higher credit scores, more savings. So these jumbo loans don't so-called need the commitment from Fannie Mae to be sold in the secondary market because they're made to wealthier borrowers. So I like to talk about this topic because I'm predominantly a second home and investment market. I do certainly love making primary residence loans, but we're on the Outer Banks. People love to vacation here, so they really are buying houses as either second homes or investment properties. So it has this change has an outsized effect on the Outer Banks and other resort markets, because if you keep increasing it, that means more loans fall under this umbrella. And specifically, second homes and investment properties are treated differently than primary residences by Fannie Mae and Freddie Mac. That's not always been the case. Second homes and primary residence rates were the same for the first 30 plus years of my career. When I started in banking, probably in 1985, I don't know what it was then because I was a newbie and I went in the mortgage side, but it's by recollection, I've never heard it changing until it did in 2022. So for the vast majority of my 40-year career in mortgage, it has, or in banking, I should say in total, that it didn't make a difference where you got a primary residence or second home, the rate was the same. That's not true anymore. That changed in 2022. They created these things called loan level pricing adjustments. The perception was that second homes were basically for more affluent borrowers, even though they're conforming loan amounts, and a lot of them are sort of upper middle class. They're not really super affluent, as I would call it. They're upper class, but they're not rich in the sense that they have to work and save or they will not have a good long-term retirement. So anyway, the point I'm trying to make is that the rates for second homes in 2022 became essentially the same as primary residence rates, which made no sense to me. I thought it was one of the worst decisions Fannie Mae had ever made. Of course, it hurt me and my market and my buyers more than anybody else. And there wasn't a quick solution because they basically raised the rates for second homes to the same rate as investment properties. And why I say this made no sense is because investor rates should be higher. An investor rate means that the borrower who's borrowing the money makes X amount of dollars, and that without that income, they would not qualify. An example would be this: a current borrower who makes $10,000 a year, affluent by a lot of people's idea, $100,000 a year, $10,000 a month, using this as a simple number, he comes to us with $4,000 a month in debt. That's a 40% debt ratio with the $10,000 with the income. He goes to buy a second home, it's going to be $3,000 a month. That's a $7,000 a month payments in all payments, and his debt ratio is 70%. However, if the property rents for, say $50,000 a year, it's going to offset a lot of that payment, if not all of it. We do take out taxes and insurance and expenses and net out the actual number it will present to make the actual payment. But if his debt falls back to $5,000 after we do that, then because we're offsetting the proposed payment, then he qualifies because debt ratio is allowed to be 50% under Fannie Mae loans. And that is an investor loan. But without that rental income, he would be very stretched to make that payment because 70% of all his income would be going to make his current mortgage payment, the proposed mortgage payment, and other payments he had before he came to see us. That's an investor loan. A second home loan would be the borrower who makes $10,000, comes to us with no mortgage, wants to buy a $3,000 house. He has no other expenses. His debt ratio is 30%. Same income, but he gets to qualify as a second home because he is a lower risk. If he doesn't rent the house, he can still make the payment. That's how we define a second home, other than the fact that the borrower does need to use the house probably for 2 weeks or longer for it to be a second home. If you're never going to occupy the property and you're going to rent it, whether seasonal or year round, it's an investment property in most people's eyes and probably should be treated as investment regardless of that. But if you're going to use the property, which is what most people do who buy on the Outer Banks or other resort markets, certainly people that buy in snow ski areas love to snow ski. People that buy in Florida like the sun and being down in Florida, especially maybe in January or February. And so they want to use these properties. They didn't buy them for their only kids of their rental potential. They bought them because they want to visit the areas. They generally like the areas. Some of them are actually just crazy about the Outer Banks. They love it. And so they want to spend more than 1 week, and by owning a house might allow them to spend maybe even a month because there are off-season times of year and they're fun to come certainly to the Outer Banks. This time of year, we've got great weather. It's not hot, it's not cold, and there's not as many people, so you can really enjoy it. So, but again, this rule meant that rates are higher for second homes. But wherever a void is created, it begins to get filled. So that's what it also point out is that while rates are higher for second homes, this higher rate that Fannie Mae created, it's not just a little higher, it's a lot higher. If you go to a Fannie Mae loan today, you just want to buy a second home, the rate could be as high as 7.25 at an 80% loan to value. Even with a great credit score, with 1 point, that's not a good deal. Nobody's going to take that from us or anybody else. And so the void got filled as other lenders step forward to say, hey, I'll make these loans, but I won't charge the premium that Fannie Mae's making. Maybe I can charge a quarter or half a point higher and make a better loan for my company and make some more extra profit because Fannie Mae loan for primary residence, for example, today are closer to 6 or 6 1/8 maybe. Okay. And that's what happened. So lenders have stepped in and said, I'll do them at say 6.5, a reasonable premium. And I say that's a reasonable premium because, hey, yes, if you have multiple mortgages and you do own a second home, you're going to make that payment last before you make your primary residence mortgage. They are not as safe as a primary residence mortgage. They're a higher risk for the lender. So honestly, a small premium, a quarter or 3/8 in rate is warranted, not 7.25 with 1 point. So these are just ranges of rates and not actual guarantees. I'm just giving you an idea of where the rates could be. But that is what has happened. And not every lender has decided to step in. So I think it's important to note that I think that independent mortgage companies are better suited to help second home buyers because we basically work with corresponding relationships with people, lenders, where they have different options. It's crazy how many options are out there. Being an independent mortgage person for really the second time in my 40-year career, which is only about a 4.5-year stint before that, after the financial crisis. This time, there is no financial crisis. I just chose an independent mortgage company because that's rather what Alex wanted to do. And independent mortgage companies today don't have any cloud of the financial crisis. So they're very inventive on things that they want to do to get people into mortgages. And they can go out and find these correspondents, investors, portfolio lenders, whatever you want to call them, that are willing to offer these programs at really competitive rates. Whereas if you work for a certain bank, they may just say, we're not going to cater to second homes or change our policy. We'll sell them to Fannie Mae. That's where the money is for us. And if we don't make as many of them, then that's okay, because we make billions of loans every month if you're a big bank. And they also have other income streams. They have deposits, they have investment banking, they have brokerage. That goes on and on about how banks make money off of you as a consumer. Mortgage companies aren't like that. We don't have deposits. We're just solely a mortgage company. So we only make money by making mortgages. That's our only income stream. We don't have any other source of income. So if we're not making mortgages and offering attractive options, then we can't be in the business. So anyway, the void's been filled, and I think that's important to point out. But I do think the conforming limit, as it increases, it snars more people in it. It's worth to be pointing out. So where do we see it going in 2026? Some numbers have the new conforming limit being as high as in the 840 range. But this week, after some searching and Googling and chatting and looking at different options, it looks like it's going to be closer to 819 plus or minus, probably not as high as 840, but somewhere around 819. It has gone up a lot over the years. I think when I first got in the mortgage business, it was probably around $185,000 business, $1,000 a year per mortgage. I remember not even that many years ago, it was just $450. It took off and really got accelerated in the financial crisis. And of course, when prices took off recently over the past few years with COVID, it actually even ballooned even further. So it's hard to believe that the conforming limit, considered affordable, is now $800,000 plus. Hope you have a great Thanksgiving. It's a short week. These people aren't even working Friday. I'll be available if you need me. And thanks a lot. We'd love to see you like our channel or subscribe also below. So thanks a lot. Have a great week.